You're watching Money Talk Viewpoint, and I'm Chantel Leeson. Successful businesses have one very common factor, and that is they have an ongoing stream of the right prospects who become clients or customers. And that's good marketing. And that's what we do. Reach out to one of our specialists today at moneytalkviewpoint.org. Let me have our first guest on for the day. And actually, he's our only guest for the day. He's also a co-host on our show. And this is Stuart Kruse. Stuart is a chartered financial analyst, a Quant Investment Advisor, TEDx Speaker, published author, a venture capitalist, and he's the CFO for Virtual Family Office. Stuart, thank you for being a co-host, but thank you today particularly for sharing yourself with our audience. How are you?
I'm doing great. Thank you for that lovely introduction. You make me sound better than I actually am, or at least that my kids think I am.
Well, kids love their dads. You're a great dad. You talk about your kids, and I appreciate that. You know, I wanted to ask you, how did you happen to get started in asset management?
Well, that's an interesting journey. I started off in chemical engineering because I just gravitate towards those kind of sciences, mathematical approach. And quite frankly, when I was in that area, one of my buddies was getting his MBA, and I thought that couldn't have been the most boring thing to do on the planet. I just couldn't conceive of why he'd want to listen to somebody talk about finance all day. And then not very much longer after that, I went to get my own MBA and just kind of looked for a home, really. And I was in some venture capital. We started a real estate investment trust of golf courses back in the late 90s. As you can imagine, in the late 90s, when every .com was exploding, nobody wanted a REIT paying 6%. So that failed eventually. And ultimately, when I was saying, hey, what do I want to be when I grow up? I decided to explore the asset management space. So I got my desk in the late 90s with Lehman Brothers out in New York. So that was the journey.
Good start. That was a great start there. Let me ask you now, I noticed that you moved into the quant investment space. What made you focus on quant investing? Quantitative investing, I'm sorry.
Quantitative, same thing. Well, as I mentioned, my event and just the way I think is mathematical. And so when I first entered the business of finance, it became really apparent, especially on the retail side, that investment advisors, portfolio managers, mutual fund managers tend to not be very good at their job. Like most retail advisors are more relationship managers. They spend much more time, and there's nothing wrong with being a relationship manager. I mean, people need to have their hands held through crises like we're going through right now. But for the most part, they don't manage the portfolios. They don't do the work. And then when they farm it out to these portfolio managers or to kind of rely on analysts, when you look at how those performances are, it's actually pretty bad. And so in doing that, I was kind of struggling with how can I add value and how could I sell? Because that's what I was being asked to do. How can I sell to Mrs. Jones this portfolio or a group of portfolio managers that are underperforming over time? And then when I was at Bear Stearns and Lehman Brothers, I had to sell it at a premium price. So underperformance at a premium price. And I was having a real hard time with reconciling those two things. And I honestly was like, I might have to get out of this business because I don't want to sell. I want to add value, right? And so I said, well, all right, let's take a step back. If I were managing money, I don't have the resources to create a team of analysts and build all that infrastructure out, but it doesn't seem to work anyway. So let's look at a different route. And I just asked a very simple, fundamental question. Are there characteristics of companies and stocks in today's point in time that tend to lead towards outperformance a year from that date? It's a pretty simple question. Like, do I buy low PE stocks that tend to be at a good value? Or do I buy high PE stocks that tend to be those growthy fund names that can explode in the upward trajectory? And I just didn't know the answer to that question. So what should I do? So I did the work. I did the math is what happened. And I started looking at all the different characteristics to see if there were any statistical advantages in the marketplace. And I said, if there are these advantages, why not just buy those stocks? Let's forget all the other stuff and just buy the stocks with those advantages now. I'm not going to be right every time, but in theory, I should be right more often than I'm wrong. And my best analogy is like Las Vegas, right? So when I personally walk into Las Vegas, I'm a player and I'm gambling because the odds are against me. I have walked out of Las Vegas ahead. Like for the weekend, I've come out, maybe a few $100s ahead, but there's a mathematical certainty that if I continue to play, and I'm not cheating or counting cards or whatever, but if I continue to play, that I will end up losing that money. But as the house doesn't certainly win every single hand, or else the player would never show up. But the house always wins over time, and it becomes a mathematical certainty that they win. And so that's what I wanted for my clients. I wanted to slant the odds in their favor so that if I invested their money with the odds in their favor enough times over enough years with enough strategies, that eventually become a mathematical certainty, just like the house wanting to play more hands against more players.
Something I got to say something about what you just said. What I hear in your statement is that you really care about what you're doing. You care about the results of the clients. And I'm saying that because what's happening in our industry is that there are two sides of the equation. And some people just sell because they're going to make a commission. But I think what people want to hear is that not all financial professionals are out just to make a commission. We want to do the right job. And I think you just made that point very clear.
Yeah, I think it's important. I just had somebody ask this question, like, what would you do or how would you operate your business if you couldn't get paid unless you perform for the client? Not that, hey, you already got the money and I'm just trying to keep them on board, but what if you didn't get paid unless you performed? And so we actually have a pay for performance option. I'm fine with that. Like, I am completely fine with that. If I don't help the clients reach their goals, why are you paying me? If my plumber doesn't fix my sink, I'm not going to pay him, right? I mean, why wouldn't I adhere to the same standards to some extent, right? If I can't help them, don't pay me.
Wow. I like the fact of plumber. My dad owned a plumbing business, so I know that feeling of paying, make sure the plumber is paid.
Yeah.
What I like above all is that you're letting people know that there are quality people out here. Not only do you understand the fundamentals and the technicals of what you are doing, but you're doing it for the sake of giving the client the best results. And you're not just running out numbers.
Right. 100%.
I understand that you've got a book coming out pretty soon. Can you, I hope I'm not jumping too far ahead. Can you share with us about the book getting published pretty soon here?
I'm trying. So I'm in editing phase right now. And as anybody who's written a book, or at least a lot of people, it can be a multi-year process. And this is exactly what happened with mine. But the book is called License to Steal. So the genesis was when I first got my Series 7. I was at Lehman Brothers. We were studying. I was in training. Series 7 is your license that gives you the ability to trade stocks. And so I got my Series 7. And one of the bigger producers that were at Lehman Brothers, this guy makes multi-million dollars a year. He comes by, he's like, hey, did you pass? We all got our results, right? Did you pass? I said, yeah, I passed. He said, congratulations. You now have a license to steal. I was like, oh, that's not what I was looking for, right? Again, that's the mentality. I was in New York. It's a pretty cutthroaty environment in some cases. And that was kind of his mentality. And I'm like, that's not what I want my mentality to be, that I want to be able to steal from my clients. I can generate trades to actually take money out of their account. That was not what I was hoping for. So the book is License to Steal: How to Turn Wall Street Greed into Your Gain. And what it is all about is quantitative investing, kind of pulling back the curtain on most of my quantitative research that talks about, what happens when you buy a low PE stock versus high PE. I didn't really mention that, but what I found is buying low PE stocks tends to win over time. And it tends to win like the last couple of years. Well, since 2021, that method has crushed it. But prior to that, the 2 or 3 years before, post-COVID, when the government was throwing a bunch of money at the economy, expensive stocks were getting more expensive, buying higher PE stocks won. So when you look at over the last, let's say 50 or 60 years, in any 3-year rolling window, buying a basket of low PE stocks tends to outperform 2/3 of the time. So 1/3 of the time in a 3-year rolling window, it does not outperform. So that's by definition 3 years of underperformance. And then you got to imagine there are periods of 4 and 5 years where that whole strategy would underperform. And of course, no client's going to wait 5 years. I mean, unless you're actually Warren Buffett, who says sometimes I have to wait 10 years, but no client is going to wait on you for 5 years and go, look, be patient. It's coming. The performance is coming, I swear. And so it talks about a bunch of other strategies that tend to work over time. And as you build them into a multi-factor model, how can you outperform the S&P 500 when 60 to 80% of fund managers actually underperform?
You know, actually, that's in that Warren Buffett style, though. He's a value investor. He's for low PE stocks.
Yeah.
And I think it's just after many people saw the movie called Wolf of Wall Street. That was the exact opposite.
Exact opposite.
That was the highest PE you could find to get churn and burn type of process.
Exactly right.
And that's the kind of person you don't want.
And so buying these kind of stocks and making these investments are certainly not sexy. And you're not going to be in the locker room or on the country club talking about, hey, I bought, I don't know, Tesla. Like Tesla is a very hard stock to value on its valuation. And so according to my methodology, I'm not saying Tesla's a bad stock or a bad company. It's iconic, right? It's amazing. But from a valuation standpoint, you tend to not be able to pick a Tesla in there. So I might miss the Tesla and I might have some very boring stocks, but over the long term and as a basket and group, I will tend to outperform because for every Tesla that is this, high flyer, you get these fallen stocks that just crush the value of the overall portfolio. It's really hard to keep up with when you have these things that fall 60, 70, 80% sometimes, like we've seen in this current environment.
It's only for short-term investing when you're buying stocks that have very high PEs. But I think if you're looking at long-term stocks, you're looking at generational stuff too. You're looking at not only paying your kids' college education, but you're also looking at things you pass down to the great grandkids you'll never see.
Right.
Yeah, like building really quality portfolios. You're a virtual family office. Can you share with the audience? They need to understand what is a family office, first of all. And I'm sure that financial advisors who are listening, and there are a lot of RIAs, registered investment advisors who are in a private practice. They don't really know the difference in what it is, but can you explain to us the difference in a family office and then a virtual family office?
Sure, glad to. Great question. So thank you. Family office, I believe it was started with the Rockefellers, right? So they had so much money, they hired financial advisors and estate planners and CPAs and private equity people to manage their money and their investments and to ensure that their assets were basically in the best possible hands and being able to be used efficiently and effectively with all those team members working together, right? Now, when I was managing money, when I first started off, it was just me and I'm just focused on investing. Like I am just investing, like give me your portfolio. I can manage, give me $1 million portfolio. I will manage your money. And that's all I'm doing. And if the CPA called me and said, hey, I need the capital gains and loss report for the year, I would send it to them. But there was no real collaboration, right? So a family office is, I have a family amount of money that is so large that I can afford to hire a team of professionals that are working together in conjunction to make my assets reach its full potential. All right. Now, if you're working with somebody less than, I'll call it $500 million, even $200 or $300 million, like $100 million, you can imagine if I'm hiring teams of professionals, that payroll is going to be in the millions, right? So you can't quite afford to have all those people on board unless you actually have $300, $400, $500 million and up. So for clients that maybe have even 50 million, they can't afford their own family office. So what a virtual family office is we bring all those people together on a platform and give the client access to them on an as needed a la carte kind of basis. So my clients that I work with are generally millionaires, and they certainly don't need the services of a family office 100% of the time. But most of them need some of those services some of the time. They have they might be making more than $1 million a year. So they have tax mitigation opportunities. They might have a bunch of real estate. So they have cost segregation studies that they might need. They might own their own businesses. So they might need to have buy-sell agreements or business valuations in place. They might need premium financing or a variety of other structures that I do not take care of. It's not in my investing lane, but my clients certainly need those services. So a virtual family office is basically, can I provide those services on an as needed basis? And then we pull in the CPA and the estate planning lawyer and whatever experts we need on the outside. And we work together as a team, because me working in my own little silo with a CPA working in his silo is going to be less effective. It doesn't matter how great we are at our individual jobs. If I can get together with the insurance guy and the CPA and the estate planning lawyer, and we can come to a conclusion as what's probably the best for the client. Like I might present an option for the client, and the CPA would say, hey, it's just not going to work for him because of XYZ that you don't even know about. Okay, awesome. Then let's pivot to a better solution. What do you think will work? Well, this might work. Okay, well, we have this other expert that we can bring in. Let's present that solution to the client. And we're working as a team, just as if the client has their own family office in that moment. So that's where the virtual family office is.
You know, the good part about that is that there are a lot of small businesses, and not even that small. They may have 50 to 100 employees who are probably worth 40, 50, 60 million dollars, not at the $100 million level yet. Maybe they're 25 million on their way up the ladder. And that's what happens, is that they piecemeal it.
Yeah.
They have the financial guy over here putting money into a retirement account or whatever else they're doing. They have the insurance guy doing things for him. The CPA does something else, and nobody knows what the other guy is doing. And they're afraid to share that advice.
Right. It's so easy to get into that mode of just, I need to protect my little fiefdom, right? And quite frankly, that's how I used to operate. It was much easier. Like if I had an insurance person present something to my client, then I'm losing business, right? I'm just actually losing business, because the only thing that's going to happen is I'm getting assets taken out of my pool of management where I'm billing from, and it goes off to insurance. So what am I going to say? No, go ahead and buy that insurance. I'm going to say, no, it's not good for you. You know, it is the worst thing for you. You should not buy insurance. Now, maybe they have a bunch of kids and they need to have the insurance in case something happens to them, and it is appropriate for them. So in this model, you're bringing everybody on. And same thing, I like have several examples of what you said. And if you're not incorporating and bringing everybody in and working on the solution, then quite frankly, you're probably not doing the best thing or acting within the best interest of the client. And I am, in theory, a fiduciary. And so as a fiduciary, I am supposed to act with the best interest of my clients in mind. But if they're bringing me things that are conflicting to my financial advancement, then I'm conflicted. So what do? Well, the best solution now is to bring everybody in. I could argue that if you are not bringing everybody in, that you are not acting as a fiduciary for your client.
Not only is that right, but you'll find the person who's gone to someone who's a CPA, but he also sells insurance and mutual funds on the side, or maybe he's a tax attorney. Yeah. That's not a family office. That's one guy making all the decisions. Some people think, they'll tell me, I've got all that already. And you'll find out he's got one person doing everything. And that you need to have those different minds that work together in a collaborative effort to bring the best results for the client. And that really is the big difference.
Yeah. I mean, think about how are you going to be the expert in everything? If you're, let's say, I love to use analogies. You're sick. You're not going to go to a generalist doctor to have your brain surgery, right? I mean, or have your knee surgery. Like you need somebody that's specifically the anesthesiologist comes in, the nurse practitioner comes in, everybody comes in and does their particular job because they're good at it. Now, probably that general practitioner pretty much knows how anesthesia works, pretty much knows how these things should go, but is that what you really want for your assets? You want somebody that's kind of this general practitioner that has a vague knowledge of these things, or do you want an expert? Like the tax code's 75,000 pages, right? And so our experts are experts in a few hundred of those pages. They're just really good at what they do here. So if you're selling your business for $50 million, I may have a good idea about some estate planning tools that you might use, but I'm not going to know exactly what that is the best thing for that particular client. So we bring in an expert in that area. And then to invest the assets that are going into these various trusts, you might have a CPA that knows that you can buy some mutual funds and do an allocation, but are they really going to know how to maximize the returns of that portfolio? I would argue probably not.
But let me ask you, one, I want clients to know if you are in that position, don't get stuck there with your financial advisor. Now, I'm not saying don't keep your financial advisor, but we're saying from a broader perspective, look beyond that. And that's why you're looking to Stuart today. Stuart, let me ask you about the mistakes that DIYers do. Do-it-yourself people. What are some of the mistakes they make?
So I'm a big student of behavioral finance, right? I am just fascinated because I have so much math background. I'm fascinated when people act either not in their own best interest or just act unexpectedly. It's fun to see how that happens. And so study after study will show that most do-it-yourselfers underperform inflation, but their recollection is that they do great. So probably some people in the audience are like, that's not me. But when you go and look at their actual performance, what happens is they honestly just have selective memory, right? They remember their winners and they mentally sweep their losers under the rug, and they don't really have an appropriate scorecard. And so what ends up happening is they feel like they're doing better and their strategy is better than what's actually happening. So they end up making emotionally charged decisions. And especially dealing with your own money, it becomes even more emotionally profound for you. And again, lots of studies will say emotional investors tend to fare worse than non-emotional investors. And quite honestly, you can just look through some of the best investors of our time have been diagnosed with, let's say, Asperger's. Like they just have some emotional deficiencies, call it. They just don't make decisions with emotion, and they tend to be better investors. So what happens is do-it-yourselfers will make decisions based off emotion, and they end up eroding so much value of their portfolio that they underperform inflation. So they're actually eating into their own purchasing power. Now their account might be going up, but not as fast as, let's say, inflation. And so they don't really have a good measuring stick for how well they're doing. If they had an advisor, like a professional guy, you could be sure that they were like scrutinizing them very well, but do they put their own scrutiny to themselves? And then another thing I also see is they get very focused in an area. Like best example is tech, right? They want to invest in these fun tech companies, which they should invest in these great tech companies because they are going to change the landscape of our economy. But that is not the only investment option out there. And if you're like, hey, I'm completely diversified because I have Tesla and I have CrowdStrike and I have, Amazon and Microsoft. Yeah, you've got a bunch of techish companies, but you have no real diversification, and they are pretty highly correlated. And then when tech crashes, they get burned considerably. So they tend to not be able to look at anything outside their purview.
Not only that, I think that emotional investors, even though they think they're doing the right thing, they really do get panicky when the market looks bad.
Yeah.
They will run to safety into cash because someone's saying, move your money to cash. And they'll say, well, I've read so-and-so move my money to cash. Well, if you move money to cash, you may or may not be making the right decision. And then I think that also a lot of emotional DIYers have a herd mentality.
Yeah, very true. That's very true. I think, the joke about economists is why did God make economists? So he can make weathermen feel better about their predictions, right? So you can look at an economist, and if they're all on one side, like, hey, interest rates are going to rise, you can kind of be sure they're going to go the other way. And it's very similar to do-it-yourselfers. If it's just known that X, Y, Z is going to happen, then it's probably not really a great bet. It's probably going to be the opposite. And even if it does happen, you're not going to be rewarded for that risk. If it's all public knowledge, then there's no reward. Just get out of it. So it's often not the best play anyway, even if you're right.
And sometimes what investors do is because they follow other people's advice without knowing what they're doing, they'll buy the wrong stock at the wrong price.
Yeah.
And sell the right stock at the wrong price. Wind up having a portfolio that looks like a yo-yo. And they'll tell you, but look, I made money. But if you look at the whole picture, maybe you didn't do as well as you could have done if you had the right strategy and the right people behind you.
It's a lot about discipline as well. And again, I'll go back to that behavioral finance. Like one example, I I use this, and I'm always curious to see what somebody's going to say, but I'll say the majority of people answer this the way I'd expect. And the question is, if you're buying stock A and stock B, and let's say you bought $5,000 worth of stock A and $5,000 worth of stock B, and the stock A goes up by 10% and stock B declines by 10%. And now let's say you're going to go on vacation and you're choosing to sell one of those stocks. Which stock do you sell? Do you sell A or do you sell B? Now, I'm not going to put anybody on the spot, but maybe for your viewers, just think about this. Would you sell the one that went up and you could say, hey, I took a profit? Or do you sell the one that went down and you're saying, I basically took a loss on that? Now, when I ask this question, and I've asked it a lot, most people say, well, I can't sell the one that took a loss. I have to wait for it to come back because it's going to come back. And I'm going to, as a famous TV personality says, I'm going to ring the register and I'm going to sell stock A and take that profit. But the reality is momentum tends to work. Relative strength tends to work. It's in the math and it tends to work. Doesn't work all the time. But you should sell and cut your losses in stock B. There's a reason why it's in decline when this stock is moving. There's a relative strength issue here. So most do-it-yourselfers, they tend to say, like, I want to notch a win. And I haven't really lost any money yet because I haven't sold this. But they're acting not in their best interest because they haven't done the research. They haven't done the math. And so their ideas are flipped, is what happens.
But also I think that a lot of people get the wrong advice overall because they're taught to keep their losers because they know they'll go up eventually. And they're taught to take profit off their winners. Why would you sell something good?
Yeah.
Just hold. I mean, one thing Buffett does, he buys quality and keeps it.
Keeps it for a really long time.
Yes. But people do invariably, though, they'll buy quality. It'll go up and say, okay, I've made my profit. Let me get out of it. Why are you getting out of it?
I use a bunch of analogies. So a favorite analogy is, especially if somebody doesn't watch or like football, and I'll say, do you know anything about football? And they're like, no, I hate that sport or whatever it is. And I'm like, okay, great. So that's perfect. But you do know football exists, right? And they're like, yeah, okay. I'm aware that it comes on every Sunday and Thursday and sometimes Monday and whatever. So I'll say, if I had to ask you which teams are going to do better in this coming season, the teams that made the playoffs last year or the teams that didn't make the playoffs last year, as a group, which do you think is going to do better? The teams that did really well last year or the teams that didn't? Like the teams that didn't, are they going to regress back to the mean and just all of a sudden do great? And the teams that just really did well, they're just going to fall off and it's going to be kind of a flip-flop. They're like, well, no, the teams that did great are going to keep doing great. Yeah. And why is that? I don't know. Yeah, you don't even need to know. You don't need to know. It could be the coach, could be the players, could be youth, could be the offense, could be the defense. You don't need to know. But you do know they're going to outperform. And so the analogy is, we bet on the stocks or the companies or the sectors that are making the playoffs until they stop making the playoffs. It's a relative strength thing. It's a pretty easy analogy that works in stocks. It works in companies. It works in countries. It works in sectors. But eventually the stock will stop making the playoffs. And then there's a relative issue with that. And you kind of step back and say, I don't necessarily need to be playing or betting on that team anymore. Don't get married to that team. Like, it's not your home team. Like, I'm a Pittsburgh Steelers fan, which I probably lost a bunch of listeners for that, but I've known the Steelers since the 70s and just love the terrible towels. And I was a receiver growing up. So Lynn Swann and John Stallworth, they were kind of my heroes and everything. They're not going to make the playoffs this year. So, but I'm still going to be a diehard fan because they're the Steelers. But don't treat your stocks like that. Don't treat your investments like that.
I think the bottom line is, particularly for the DIYers, just do a little homework and find the right people.
Yeah.
And just do a little homework. And that's why we're on this show today. So they can meet you and meet me, but you can find that by looking around. Somebody who knows what they're doing.
100%.
Listen, KAM is Kruse Asset Management. What's the market forecast? And what should the investors do now?
So that's a $64,000 question, right? Everybody's kind of wondering this. We talk about this daily within my office and have spirited debates about what's going on. But this is what I'll tell you. And again, this is mathematically driven. Back in January, we put out a video, January 6th, not the auspicious January 6th day, but January 6th of this year. We put out a video that said, the PEs of the S&P, the forward PEs of the S&P were above 20, 21, 21 and a half. From that point, in the history of the stock market, we have never seen good forward 5-year returns. It's never happened. So you've seen the best, the pinnacle was a roughly a 5 or 6% annualized average return. That was the best that we could hope for. But when you looked at the regressions and the numbers, the average annualized return was 0%. So what we argued were, you're going to get at best mediocre returns, expected returns of 0%, and maybe at worst a pullback. And alongside of that investment, you're going to have volatility along the way, of course, because you're invested in the stock market. So the risk reward wasn't there for us. And so we started reducing our risk. At that time, inflation was 1%, right? So we did reduce a bunch of risk in our client's portfolio. And then the market started breaking down from a technical standpoint, and from the relative strength, the whole football analogy, equities, large cap, mid cap, international, emerging markets were all going out of favor and all looking to be like they weren't making the playoffs. So we pulled back further out of our equities. And as everybody knows, the market fell 20%, rallied from June to August. It rallied for 60 days, and another 10% back and 50% retracement. So what does that mean? From top to bottom, it retraced back more than 50%. And that is often a sign that the bottom was in. So it just barely made over 50%, but then it installed another bottom and went through those bottoms again. So today, you asked me, where are we today? Well, the long-term average PE of the S&P 500 is around 15, call it, okay, 15, 16. So PE is, what am I willing to pay for $1 of earnings today? Price divided by earnings, PE. So a $15 PE, saying I'm willing to pay $15 for every $1 of earnings in the S&P 500. That's coincidentally kind of what Apple was trading at for quite some time pre-COVID, between 12 and 18. It was averaged of about a 15 PE. Very reasonable PE. So we were trading at interest rates of our inflation rates of 1%, and Fed funds rate was at 0, and the 10-year was, hit 50 some basis points. I mean, everything was compressed. So all those forward earnings of a company could be discounted back to almost the same dollar today. So that PE could expand because interest rates were really low. So there's something called the rule of 20. So if you add PEs plus inflation rate together, and if you're over 20, the market's expensive. So we were already over 20 with the PE ratio, and if inflation was around, let's call it 1%. So maybe that PE plus inflation was 21, 22, 23. So over 20, so expensive. And that's where we called the market and said, let's get out. Incidentally, the market peak was January 5th. So we were pretty close. Today, the PE of the market is 16, 17, somewhere in that range. So not cheap. And normally you see the market go from expensive to cheap. Like we went through expensive, and normally if you look at it, it doesn't stop at fair value. It goes through fair value to cheap at some point, especially in a downslide. So we're still expensive, but inflation is no longer 1%, it's 8.5%. So I could argue that if we're at 16 multiple plus an 8 inflation handle, we are arguably more expensive than we were in January because of the inflation rate. I could argue there is another, we're halfway to this. If you look at all the recessions that we've seen in the last, 50 years, like 8 or 9 of them that are this type of recession, if you look at the average length and the average pullback of those last 8 recessions, not including COVID, because I would argue COVID was an anomaly, right? You had top to bottom decline of 36%. It happened in 33 days. It was the fastest top to bottom decline we'd seen by a factor of 2. The Fed threw $6 trillion at the problem. And now they are actually taking money out of the economy, not throwing money into the economy, right? So the exact opposite mechanics is happening. So if I take COVID out of that, of the last 9 recessions, they lasted over 500 days and had a drawdown of 40%, 40%. So we're 10 months in, just 11 months, I guess it's November. So we're about 11 months in now. And we're about 20% down, hit a bottom of 24 and change. So I could argue we have another 6 to 9 months to go just to get to average, not even to get to a bad recession, just an average pullback. So I could argue we'd have another 15 to 20% to go and another 6 to 9 months. Now, if we look at what's happened, the Fed, as you know, raised interest rates another 75 basis points yesterday. They've had multiple 75 basis points in a row, but none of those raises are in the economy yet. None of them have worked their way into the economy. So none of those headwinds have hit the economic landscape. So we are having this pullback based off of still all the stimulus and none of the quantitative tightening that the Fed is engaging in right now. And that usually takes about 6 to 9 months. And so the three things that have preceded every recession we've ever been into have been Fed tightening, which we have. Now, one of these three things precedes. So Fed tightening, which we have. Inverted yield curve, which we have. So not only the 2 and 10-year extremely inverted, but the 10-year and the 3-month treasury are inverted now. That's an extreme position. So the federal government will pay you more for a 3-month treasury than they will pay you for a 10-year treasury. It's a really extreme position to be in right now. And higher energy costs, which we have. So we have all three of those conditions that have met right now. Most economists would suggest we are not in a recession today, but yet we're probably going to be in one. So that says things are going to get worse, not better. So again, you asked me where we think the market's going to go. The market tends to look forward 6 to 9 months, but 6 to 9 months is about when all these things from the Fed tightening landscape hit. And it's about when we're predicting a recession. So we're looking into the recession. So markets often can look through a problem, but we can't see through it yet. We're not even in it yet. So we don't know what's coming. So what I think is going to happen is we're going to have another leg down. So we called after that rally, we called for leg down. We reduced equity again. I wasn't sure if it was going to break the low, but since it did break the low and 2/3 of the market trades on technicals, we expected some sort of Santa Claus rally and then another leg down. So my supposition is we're going to get another leg down and perhaps have some more pain ahead of us. And my final point to that whole thing is, again, we're down 25%. This has been going on for a while. If I've been doing this for coming up on 25 years now, normally when you see a breakout point or a bottom, you see panic at some point in the market. You see just indiscriminate selling of everything. And we just have not seen that yet. Like there have been some big day losses. There have been some days where it's been down and it's not been fun to be in our position where you just see a lot of red on the screen. And we've had huge rallies, but we haven't seen any panic selling yet. And almost always that's what it takes to call that bottom. And we just haven't seen it. So, and it normally like trends down, up, down. Like even in the up markets, you see down months. And so in the down markets, you're going to see up months. But that last down leg is usually steep and we just haven't seen it. So I think there's a lot more risk to the downside than missed opportunity to the up.
Wow, we covered, you know what, we're getting ready to wrap up our session together today. First of all, I want to thank you for that. I want to thank you for your presentation, everything you talked about today. And for all the people that are listening, either whether they're listening presently or listening to our replay on YouTube, I want to know how to reach out to you and tell us also what type of client you will accept.
So, we would want to work with the people that we can help the most, right? Is it the person that it has like an account that's $50,000 and, they're not making a boatload of money and there's not a lot that we can do for them? I am happy to meet with any friends and family. I've always had that policy from the beginning. I am happy to meet with you. I'm happy to we'll give you a free analysis of your portfolio, even if you're not our ideal client. I have seen so many bad portfolios and bad advice out there that it actually pains me. It's a whole nother show of just like amazingly bad advice. But we will give you a blueprint on what to do and how to do it. But an ideal client is either a high income earner where we can help them with both aspects, help them with our lane of financial investing, and on the virtual family office side, help them mitigate their taxes, help them plan for the future, help them put their insurance in place for premium financing. If they're business owners, help them with, everything that goes along with that kind of business side. So my typical client tends to be, $2 to $10 million. I've got clients below that, clients above it. But that tends to be my sweet spot of where we play. So we do have people in our firm that are not as gray-haired as me. So, they are happy to talk if you don't want to talk to somebody as old as I am. We have CFAs at our firm as well that can talk to you that maybe have a little bit more relevance to what you're going through if you tend to be a lot younger than I am. So happy to talk to anybody at all, because we do not want to be, so I don't want to be in this business for greed and to just say, hey, you don't have quite enough money, we can't help you. We want to make sure if you're coming through our door that you're taken care of. Number one, first. I don't want you to walk out and go, oh, that was not helpful. We will give you a blueprint on what to do. But how you get a hold of us? Best way to get a hold of me would be Stuart, STUART, at KruseAM.com or Kruse Asset Management.com, all spelled out. And Kruse is KRUSE. You can reach out to me on LinkedIn, which is LinkedIn at Kruse AM as well. And then we have a YouTube channel that you can see. Again, Kruse AM. And so those are probably the best ways to reach us.
Stuart, thank you for being with us today. And I want to tell our audience, thank you for being here as well. And reach out to us if you're looking to market yourself or your business. Again, that's moneytalkviewpoint.org. Stuart will also be our host for the December 1st show. And I'm out of the country, so my daughter's at school in France. I'll be in Europe for December and parts of January. So Stuart's going to do the December and January show. And thank you so much, Stuart.
Looking forward to it.
For our show today. And thank you for being our co-host for shows going forward.
I appreciate the time.